Most retail hedges aren't hedges. They're expensive close buttons. Here's how to tell the difference.
A hedge is not what most retail traders think it is. It's not a way to freeze a losing trade. It's not a delete button. A hedge is the deliberate opening of a second position to offset the risk on a position you don't want to close for some other reason. A real cash flow obligation, a long-dated thesis, a positive swap credit you want to preserve. If your only reason is, I don't want to take the loss, you don't have a hedge. You have a more expensive close. Most of the $7.5 trillion that moves through forex every day is corporate hedging. A UK exporter expecting $5 million from a US customer in 90 days has real, unavoidable exposure. That's hedging. Retail traders borrow the vocabulary. They rarely borrow the structural reason. There are 5 strategies that actually work, and one of them is banned in the US. I'll come back to why. Start with the simplest, the direct hedge. You're long one lot of Euro USD. You open a short one lot of Euro USD. Net delta, 0. Sounds clean. It isn't. In the US, you literally can't do this. NFA Rule 243B, the FIFO rule, says any new opposing order just nets the position down. Outside the US, at FCA, CySEC, ASIC brokers, direct hedging is legal and natively supported in MT4 and MT5 with separate ticket numbers. Here's the part nobody flags. Economically, a direct hedge is a closed position. You've removed every drop of directional exposure. What you've added is double spread, often double swap, and on commission-based accounts, double commission. So when you're tempted, ask, what does this give me that the close button doesn't? Outside of preserving a tax timing feature or an accrued swap credit, the honest answer is usually nothing, just a way to avoid feeling the loss. The market doesn't care how you feel. Now, the strategies that do something close can't. First, the correlation hedge. Long Euro USD, short GBP USD. 2 different pairs, so it's legal everywhere, including the US. Euro USD and GBP USD typically correlate at plus 0.7 to plus 0.9 against the dollar. Short the GBP and you've neutralized most of the dollar side risk on your Euro position, while keeping a directional view on the Euro GBP cross. That's the real point. You're separating the dollar from the Euro. A rough sizing rule, hedge notional equals primary notional times correlation times the volatility ratio. One lot Euro USD with 0.85 correlation gets hedged with about 0.85 lots of GBP USD. Imperfect. If the Bank of England surprises and the pound moves alone, the hedge breaks. But for a Fed meeting bridge, it's clean. Step up from there. Options. Long Euro USD at 109. Worried about downside through an event? Buy a 108 put. The premium is your maximum cost. Below 108, the put pays out. Above, it expires worthless and your underlying position is untouched. Define downside, full upside. US access is through PHLX listed currency options at Interactive Brokers, Tasty Trade, and TradeStation. In Europe, vanilla FX options through Saxo and a few specialty desks. This is the cleanest hedge structure that exists. It's also the one institutional desks default to. For US traders blocked from direct hedging without options access, there's a 4th option, CME FX futures. Different regulatory framework, CFTC, not NFA, so a short Euro USD future can sit alongside a long spot position without netting. Contracts are big. One standard Euro USD future is 125,000 euros. Micros cut that to 12,500. Centrally cleared, transparent margin, no counterparty risk, real institutional plumbing. And the 5th, forwards and non-deliverable forwards, the bilateral OTC contract that the entire corporate treasury world runs on. Not retail accessible at standard CFD brokers. You need a private bank or a specialist platform like Saxo with corporate treasury tier qualification. Useful to know it exists. Most retail traders will never touch it.
Quick warning before I move on. You will see grid hedges, hedged martingale, locked grid EAs, recovery bots. The pitch is always the same. A system that can't lose because every position is hedged, every loss recovered by doubling up. Equity curves look beautiful for months. Here's why. Forex markets mean revert for long stretches. As long as price swings inside a range, the grid prints and the spread costs feel small. Then a regime change arrives. A central bank pivots. A war headline drops. Price stops mean reverting and starts trending. Every leg of the grid is suddenly bleeding. Each leg pays full spread. Negative swap on the losing side accrues every night. Margin doesn't net, it adds. The broker margin calls both sides. Account blown. The Forex Factory forums have years of threads documenting this exact pattern, with exactly this ending. A hedging EA promising smooth equity is not a strategy. It's a countdown timer. Before you open any hedge, run 3 numbers. 1. Spread cost per leg. Raw spread Euro USD, about 0.1 to 0.3 pips times $10 a pip per lot. 2 legs, double it. 2. Net daily swap on both legs. Most brokers run asymmetric swap rates. You don't get back what you pay. Almost always a small daily cost on the hedged pair, regardless of direction. 3. Margin tied up on both legs. Even netted hedges usually lock some margin on each side. That's capital you can't deploy anywhere else. Run the numbers for a 1-lot Euro USD direct hedge held 1 week. Spread on 2 legs, about $4. Net swap across 7 nights, $5 to $15. Commission on 2 legs, about $14. Total carry cost, roughly $23 to $33. The rule that falls out of that math: if the risk you're trying to avoid is smaller than $30, don't hedge. Close. This is the calculation almost no retail hedger actually does, and it's why most retail hedging programs underperform a simple close and reopen. So how do you actually decide? Walk it through. Position losing, you want to stop the bleeding? Close. A stop loss does the same thing for 1 spread, not 2. Position profitable, you want to protect gains through an event? Hedge, or just trail your stop to break even. Position with material positive swap, you want to keep accruing? Correlation hedge. Position is part of a longer dated thesis, but tomorrow's newsprint scares you? Options hedge if you have access, correlated pair if you don't. Using hedging to avoid taking a loss? Close. The hedge isn't solving the problem. You are. And the loop I opened with, why does the US ban direct hedging when nobody else does? The NFA looked at the data in 2009 and concluded retail hedging just transferred money from traders to brokers. Extra spread, extra swap, no net benefit. Europe, the UK, Australia, and most of Asia all disagreed and kept the option. Both regulators are technically right. The US removed the choice. Everyone else kept it. But the economics still favor the close button. Final principle: hedging is not a strategy. It's a tool inside a strategy. If your plan doesn't already have position size as a percentage of equity, stops written down before entry, a documented thesis, and a max loss circuit breaker, fix that first. Hedging without that foundation isn't risk management. It's deferral. Build the strategy. Then add hedging only when a specific structural reason demands it.
Hedging is a tool, not an escape. Close unless structure demands otherwise. Full breakdown linked in the description.